not some happy people at Bank of America. Dana Cimilluca is in London with the story. Big layoffs at Bank of America, right, Dana?
Yeah, that's right. You know, big layoffs have been going on there for a while, but they've been on the consumer side. Now it looks like they're taking aim on the, more rarefied institutional or investment banking side.
Yeah, and I mean, deeply, right? I mean, we're talking about 2,000 bankers from that unit are going to be let go. That is unusual, right? I mean, usually these are the guys that kind of survive the job cuts because they bring in the big money.
Exactly, and it's a sign of the times that some of these markets are so depressed that their banks like BofA are having to consider cuts that they normally are loath to make. Now, you do have to keep in mind, though, I mean, first of all, in the larger Bank of America context, 2,000 people is not that many. I mean, they probably lose that many in the course of normal attrition every year or more. But this is on the institutional side, which is a smaller business, roughly 20,000 or so. So, 2,000, in the context of 20,000 is, like you point out, not small.
Right. And most of these guys are coming from Merrill. Is that right? Are most of them coming from the Merrill unit?
It's a good question. It's tough to say. That deal, is now 3 years old. Many of the old, Merrill holdovers are gone. I don't think it's obvious that these are coming from one area or the other, except for the fact that, most of the backbone of the institutional business is Merrill. So in that regard, you would expect more of these to come from there than from the old Bank of America.
Dana, you said that this was a sign of the times. I wonder if you could elaborate in terms of what this says, if at all, about the state of the economy, because these are the guys who are, in charge of mergers and acquisitions, corporate bond issuance, the sort of activity that speeds up as the economy moves along. And we had some relatively strong data out today, and after all, we've had, 3 years of a recovery and a lot of assistance from the Federal Reserve and others to sort of drive that sort of activity. What's going wrong?
Well, I mean, let's just take the M&A business, which you mentioned, which I focus on. In spite of the, tailwinds that are starting to emerge in the economy, the M&A business is still stubbornly stuck in a rut, so to speak. We saw a few deals yesterday, which is mildly encouraging, but for the most part, the M&A business is not a very good one right now. And that's by and large been the case ever since the financial crisis. And I think firms are starting to come around to the possibility this is a structural change and that they're simply overstaffed, even for these relatively good businesses like M&A.
Wow, that would be interesting. I mean, look, we've seen this in all the bank earnings results. We've just seen it in general in the market. I mean, you talk about confidence for the consumers. I mean, confidence for the banks and for corporate America matters too. When there's not a lot of confidence among executives that things are going to get better, they don't do deals. They don't move on things. Right. They're issuing a lot of corporate debt because rates are so cheap.
Right.
But the things the really juicy things for the investment banking side, you're not seeing that much of. And Dana, it's not just Bank of America, right?
No, it's a good point. They're certainly not alone. I mean, the numbers here, they do seem a little bit larger than what some of the other firms are doing. But, UBS, obviously, we know has been bleeding. Even the mighty Goldman Sachs has had more than average attrition lately. Even in some cases, people voluntarily leaving that firm, partner level types who, that would have been unthinkable back in the day. But, now in this sort of new world that we're in, not so unthinkable anymore.
Some of them even read editorials in the Times. All right, we got to leave it there, Dana. Thanks a lot. We'll talk to you soon.